understand when I'm going to a buyer's agent, what they can do for us and why do I need to use a buyer's agent.
Sure.
So that we can tell them, hey, you're not paying those $10,000-15,000 in fee or whatever that amount of fee is for nothing. You're actually gaining a lot more in the period that you're going to actually keep that property.
Sure.
So for people to understand that this is what the buyer's agent's going to do for me, plus it's for time poor people.
Yeah, of course. Yeah.
You know, if I want to buy a property, I know how to find a property. A lot of people don't know that.
Definitely.
A lot of people don't understand how the rental market works, who to go to, how to get that done, and all of that stuff.
Sure.
So yeah, let's go. Alright guys, welcome back to yet another vlog. Today we are here with the owner of Investig Partner Group and Help Me Buy Property podcast. You can follow him up and I'll put all of his links in the description. Today, we're going to be sitting down and we're going to be speaking about buyer's agency and what a buyer's agent can do for you. This is a free guide to make you understand why you want to utilize a buyer's agent when you're buying an investment, why you want to use a buyer's agent when you're looking to buy an investment property or even considering to see what you can do in terms of investment. So we are here with Moxin Reza. Thank you so much for joining us today.
Hello,
I
everyone.
really appreciate it, mate.
Thank you. Thank you for having me on the show.
My pleasure. So, to start with, I want to ask you a very basic question.
Sure.
What does a buyer's agent do for an investor wanting to get onto an investment journey, basically?
Sure. Look, for the viewers and listeners, my name is Moxin. I help create sustainable and scalable property portfolios without impacting lifestyle.
Fair enough.
And so when you think about buyer's agent, I always divide buyer's agent into two categories. One is an owner-occupier buyer's agent, and the other one is an investor buyer's agency. An owner-occupier buyer's agency is there for people who are time poor, frustrated with the process, attending auctions, opens, etc. all the time. And so an owner-occupier buyer's agent would not only use the relationship to get the properties well before they sometimes even hit the market, but also get it at the price that is fair, undervalue. They would be there supporting you in an auction. So a lot of people who are first home buyers, they get quite jittery, and the buyer's agent is providing a lot of value in that space.
Yeah.
When you talk about the investor buyer's agency side of things, a lot of these things are still applicable, but with an investor buyer's agency, there is more.
Yeah.
Now you have money on the table because you're trying to get the returns.
Yeah.
And so an investor buyer's agent is, number one, helping you strategize as to where to buy, what to buy, when to sell. So they're looking at your property portfolio, reviewing your property portfolio as to, okay, what have you done right so far? How do you make your property portfolio sustainable?
Yeah.
And then typically using his or her relationships, connections all across Australia in helping you buy the right properties at the right yield, at the right growth. A lot of investors, what they end up doing is, while they are trying to follow a DIY model, do it yourself, and they stay away from done for you model, they waste a lot of time. They end up being frustrated. They pay a lot of overpriced properties. Their due diligence is not, fully, they're not across the full due diligence as well. And so they end up either, buying in the wrong pocket at the wrong time, or the right pocket at the wrong time, or a wrong property at the wrong or a right time.
Yeah.
And so it's important that, you need to consider all of those things. I was on a podcast where I was talking about this, that I have a client who bought in Ringwood in 2016 for $650,000 property, corner block, 900 square meter land. And people would think, wow, Ringwood, amazing, right? Right now, almost $1 million suburb, right?
Yeah.
That property was sold last year for $680,000.
And why would that be though?
Like typical reason, right? So they didn't follow the due diligence process. There was an easement that was running through the property.
Exactly.
Okay. It was next to the power lines. It was next to the freeway. So anything that could be wrong with the property was wrong with the property, right? And so I still remember going to that auction for the client, and God forbid, we didn't help them buy that property. And it was just sad, right? So there was no one at the auction. The only person that was there was me, and I was helping the client basically get that, sell that property.
Yeah.
And the real estate agent didn't know that, there was a buyer's agent involved helping them build their property portfolio. And he was trying to sell the property to me. And I was like, I don't think that I'm going to buy this.
Never.
But yeah. And look, happily, you know, the
Yeah.
client is on its journey now. You know, they've purchased 4 properties between last year and now, you know, sitting on almost $400,000 in equity.
That's awesome.
And so a good buyer's agent would help you get there. You know, they'll help you buy in the right pockets at the right time, at the right price, and help you scale their property portfolio without sacrificing your lifestyle. I think that's the key. A lot
That's
of
the
people,
main thing.
yeah,
Because a lot of people think when I buy an investment property, I'm potentially going to be pinching out a lot of money out of my pocket, and then I'll have to be topping up rent up to $1,000 a month, and this is I have to pay land tax, I have to pay council rates, and I have to pay all of that stuff. But they don't understand that there are properties out there which are positively cash flow or just break even. In this market, it's very hard to find a property which is cash flow positive, but you could potentially find a property with the help of a buyer's agent, which is
definitely
right there where you don't necessarily have to put a lot of money. You could potentially have close to $3,000 to $4,000 of top up a year,
100%.
which is fair enough for an investment. You're chipping in $3,000 to $4,000 in return of a gain, which is upwards of a couple of $100,000. I believe it's a no-brainer.
Definitely. And look, I think a lot of people make decisions in a point in time, right?
Yeah.
And so you take yourself back 2 years ago and people were buying properties yielding at 3%.
Yeah.
And I was saying to people at that time as well that you should never buy it in a point in time. Just because the interest rate is at 2%, you shouldn't be going out there buying properties at 3%, calling it cash positive, right?
Those are the people on the market right now.
100%. And on the flip side right now, when the interest rates sit at about 6.5% to 7%, right? People are still making the same mistake. So they are trying to chase yields of 9% or 8% in a residential setting. So not commercial, not co-living, in residential setting, buying in mining towns where everyone has been burned. They've seen 2015, 16, right? And so don't make a decision in a point in time, right? Ultimately, if you have your strategy planned out properly, you would have a property portfolio that is sustainable on its own to pay for itself. You know, it should be enough rental coming in for pay for its repayments.
Yeah.
I always think that this notion of positive cash flow versus negatively geared is such a wrong comparison, right? Your property portfolio as an overall should always be sustainable, right? That's the most important thing. And so you would buy some properties that are super positive cash flow, but you would still buy properties that are negatively geared as well.
Yeah.
Because anything that you touch in Melbourne and Sydney right now is negatively geared.
100%.
Does that mean that you never buy in Melbourne and Sydney?
No.
No, right? Because the most premium growth comes out of these two states, right?
But then you're compensating the growth with the fact that when you sell the property, you will have massive capital gains.
Yes.
So that's what you're looking at. So you're negating the fact that you will have a little bit of extra money going towards that property. But when you sell the property at the end of the property cycle, which is maybe 5 to 7.5 years or 8 years time, you are actually gaining a lot more money that you have actually put into the property. And you have been through the whole cycle.
Definitely. And the second thing is that you're using other super positive cash flow properties to offset this negative nature of the event, right? Where a lot of people fail is that they make property decisions thinking about saving taxes.
Yeah.
Okay. And this mindset about saving is basically what gets people, below their poverty line, right? Gets into this mindset of, okay, I'm going to put money in the bank so that, the inflation can eat my money away because of this saving mindset, right? And so tax, when it comes to tax times as well, it's not so much about saving tax, it's about optimizing tax.
Exactly.
And so the more you optimize your tax, the better it is you would, on your wealth creation journey, you would get faster on your wealth creation journey as well.
Exactly. And that's the main thing as well. A lot of people don't understand. Tax is not a bad thing. I see tax as a very good thing. Why? Because it gives me a confidence that I am making money to pay that tax.
100%.
How much can I save up on that amount of tax? So if next year I have to pay $40,000 worth of tax for a property, how can I save even $500? If I can save somehow. So my accountant's going to help me in that journey where he tells me, hey, this is what we are going to do. This is how we're going to plan this property. And these are the charges that we are probably going to be able to claim from this, property portfolio. And this is how you save money.
Definitely.
And a lot of people think that, this is what we are doing right now and it's just gone. It's not the way.
Yes.
You're also making money at the same time when you're paying a tax.
100%.
So
yes,
it's a no-brainer. Government's always going to chip in.
Yes, yes. Look, I mean, taxes, they never leave you alone, right? So the idea is to be as tax efficient as possible, right? And, that's why one of the reasons business owners pay least amount of taxes, right?
Exactly.
It's basically because of that.
True. Thank you so much for that. And the next one that I have for you, this is a question that I actually asked. So what I did is I went out to a few of my mates and I was like, hey, I'm catching up with Moxin and I'm going to be asking him questions about buyer's agency. And if you were in the market looking for a property, what are the main questions that you would want to know from a buyer's agent? How can they help you? How can they help people like us? Because I mean, not everybody is property savvy. Not
Definitely.
everybody understands how the property works. Everybody knows that the property has growth, but there's a saying, timing the market is better than time in the market.
Yeah.
Right? So when you're timing the market, you don't know because you're not a professional. Your buyer's agent is a professional. He knows when to time the market. Rather than you spending 20 years in the market, you could potentially have made that money in 5 to 7 years time when you had a professional who actually helped you out. So what criteria do you use to identify potential investment properties with positive cash flows, or even strategically placing it in a place where people get to know that this is what my whole portfolio is going to do, and this is what we are trying to achieve in next 10 years time. How do we identify those pockets? How do we identify those kind of properties?
Sure. Now, before I get into a lot of details, I have an ebook which is called Secrets of Finding Investor Grade Properties that I've shared everything in there, okay? Where you talk about the property due diligence, the suburb due diligence, etc. So, please reach out and see that in there. There is a lot of information in there.
But link in description.
And I'll talk a bit about that today, okay? So when you are looking at an investor grade property, okay, an investor grade property needs to tick the first 3 boxes for you. Number 1, okay? That property needs to fit your strategy. So it needs to be within that strategy. Number 2, you can't overpay or overprice for it. So it has to be the right growth, the right yield. And number 3, that property has to have an exit strategy available for you, okay? And so selling is one exit strategy, okay? So you buy a property, you sell. There has to be multiple exit strategies available for that property. For example, you can change the configuration of the house. You can, paint it and lift the equity up. You can put a granny at the back. You can subdivide. So there needs to be exit strategies available for you with that particular investment property. Okay, and of course, the land is what's going to dictate and drive the exit strategies within the properties. Now, when you are out there looking for an investment property, okay, focus on the suburb narrowing first. So identify your price point as to, okay, this is my price point. This is what my strategy is telling me. And based on that price point, the yield and the growth target, you are going to narrow down the suburb. Okay. Now, I'm talking about narrowing down the suburb as to, okay, you might come down to 5 or 6 or 8 suburbs as to, okay, this is what I'm looking for. Now, that suburb narrowing also includes a lot of other factors, and this is where the microeconomic factors of the demand and supply comes into place. Okay, so when you're talking about demand side of the equation, you're looking at things like how many active people are looking at property right now. Okay, and when you're talking about supply side of equations, you're looking at what is stock available in the market, for example. Okay, what is the vendor discounting? What is the auction clearance rate? All of these things basically helps you indicate and identify.
What is the DOM, days on market of the property?
Correct.
That's one of the major metrics.
Correct.
As well.
Yes. So days on market versus stock on market. How much stock is available, how many days the property is basically staying on the market, how many buyers are basically looking in some of these areas. So it's called buyer's demand or seller's demand. You can find all of these details as well. Okay, they're readily available on a lot of portals like DSR Data, Hashtag, Suburbs Finder. There's heaps of portals available for you to help you make that assessment. Okay, once you're down to those suburbs and you're down to those yields, okay, now it's basically the time to find the right property. Okay, now understand that every suburb has a different mix of property that is going to give you the best yield.
Absolutely.
Okay, a lot of people think that, okay, I'm going to go for a 4-bedroom 2-bathroom because it's going to get me the best rental. The best rental does not mean the best yield. Okay, because a suburb could have a 3-bedroom 1-bathroom at a similar land size selling significantly cheaper than a 4-bedroom 2-bathroom, because 4-bedroom 2-bathroom is an owner-occupier market. And so there is a lot more owner-occupier emotionally attached to the property paying a lot more. Okay, so you need to identify that sweet spot in that suburb. Some suburbs have a sweet spot of 4-bedroom 2-bathroom, and then they disappear and it turns out around to 3-bedroom 1-bathroom as well. Okay, so that's number 1.
Fair enough.
Now, when you're looking at the property due diligence, the first and the foremost that comes into my mind right now is the land to asset ratio. Okay, so that is one thing that people should never ever bypass. Land to asset ratio is basically as simple as how close are you buying your property to the land value. Okay, if you are closer to buying it to the land value, then you would always be ahead of the growth curve.
That's right.
Okay. For example, if I'm buying a property for, say, $500,000 in today's time, say, for example, in any suburb, Western Australia, Adelaide, Melbourne, anywhere, and that property is, say, 500 square meters, okay? And in that same suburb, if I am going to go out there and buy a retail land, And if that land is selling for, say, $2,000 per square meter, okay, that land value typically is $1 million right now.
That's right.
Okay? And so if you're buying a property for $500,000, your land to asset ratio is well over 100%, almost close to 200%.
That's right.
Okay? Where a lot of buyers go wrong is that they buy properties at the land to asset ratio 50% or under. Your rule of thumb should be you should at least be focusing on 70 to 80% land to value ratio. Okay, so you're paying 70% of your price towards the land, at least 70 to 80%. Okay, so that's number one rule of thumb. Number two, when you talk about the property due diligence side of things, there is a lot of things that comes into mind. You know, stay away from major roads, stay away from power lines. You know, check on the easements, check on covenants, check the titles. You know, check the caveats. All of these things, and again, there is a whole list that you can tap into to look into it. And so all of these things basically come into account when you are basically going to identify the property. Once you've done all of this, then the real sort of deal starts. You know, the negotiation. Talking to the agents, finding the right price, comparables, making sure that it hits all the boxes. So there is a lot of work that goes into it. And so I always say that a lot of people as investors who are trying to do it themselves, they treat property buying as an event. Okay, it happens twice in the lifetime or maybe thrice in the lifetime. And so, they'll spend a lot of time, effort, be frustrated in order to try saving $5,000, $10,000. Okay? Understand that property buying is a process.
It is.
It's not an event.
No.
And that process and the actual property buying is actually happening at the tail end of the process. Okay? And so that's not the first step. That's actually the last step, right? And that's where a lot of people go wrong. They start off looking for properties first. They don't sort out their strategies. No. They don't look at the due diligence. They don't find the suburbs.
I agree on you. I agree with you on that 100%. Everybody's like, oh, I want to buy a property right now, so I'm going to go into REA and start looking for a property. No.
Yes, that's the last step. Yes, 100%. Yeah. And so a lot of the decisions that are made in the investment world, which is quite sad, and sometimes it's good or bad, are either barbecue conversations or water cooler conversations, or a friend of mine who has got 5 properties and he might have done well because he bought them 20 years ago, and then all of a sudden they are property prophets or property gurus, right? So it's important to understand that you can't go wrong if you are buying a fundamentally right property.
Absolutely.
Okay, you go wrong when you are trying to play against the market. Okay, so you're buying house and land packages in a brand new pocket, and the demand is high and the supply is low, and the prices go up, and then as soon as something like COVID happens or interest rates starts rising, the price starts to come back or readjust. So it's important that you always buy fundamentally right property, and you can never go wrong. And I use this example, and this is a funny example, but this is a true example, that if you look at the price of graves, okay. Price of graves in 2016 was
I know where you're going with this.
$1,650 per grave. In today's time, they're selling for $11,000. And that's because of the land value. Fundamentally right, high demand, low supply stock, right? And so treat your property as an investment class. Treat it as in such a way that you are buying a product that is going to be scarce in the future. And you're going to always win.
Absolutely. Plus, when you're buying a property which has the land component to it, you're potentially looking at the fact that you're probably going to be redeveloping the land. That is another potential that you have for the property, depending upon the zoning that you're in the council area.
100%.
So there are multiple factors that you're taking into account that, okay, so this property is going to give me at least this much ROI at the end of the cycle if I don't do anything to the property. Whereas at the end of the cycle, if I decide to reinvest another couple of $100,000 or another $250,000 into it, I could potentially make more than $500,000 on top of that piece of land, because I could build a couple of dual occupancy, sell one of them, that's my profit, and then you have a cash cow sitting right next to it, which actually pays you every week.
100%, definitely, yeah. And look, I mean, it's a no-brainer, right? When you step away from all of this, hush, and think about this, it's a no-brainer, right? That you need to buy something that is not on its high best value, and you're going to take it to its high best value. If you're going to buy something that is on its high best value, the only reason that thing would grow is because someone is emotionally invested in it, and they'll pay more for it. Right? It's simple as that, right?
But that's how the majority of the market works right now. Majority of people who are buying properties are emotionally, who are fully emotionally invested into a property. And how they buy a property is they go to a property, they look at the property, they're like, oh my gosh, I like this. This is so nice. And all they look at the facade, they look at the infrastructure, which is a depreciable asset.
100%.
You know, it's an asset which is probably going to go down in value every year on year.
100%.
Land is something which is going to appreciate in value, and that is exactly what you need.
Definitely.
So
definitely. And look, I mean, a lot of people don't pay attention to floor plans, right? So the actual aesthetics of the property is less important. It's the floor plan that's a lot more important, because that is what's going to help you. You know, even my own house, right? It was a 3-bedroom, 2-bathroom that I converted to a 4-bedroom, 2-bathroom, added 150,000 in equity literally overnight, right?
Yeah.
By just putting in an extra wall, because it changed the market from a 3-bedroom small family to a 4-bedroom. Now it's a bigger family home, right?
There you go.
So it's just little things that can add a lot more value. You know, we call it manufactured returns. You don't need $500,000 to become a property developer.
No
you don't need, you know, $400,000 or $500,000 to do really well into property. Okay, a lot of people start off with a basic deposit of, you know, $40,000, $50,000, $100,000, right? And they grow and build successful, sustainable property portfolios.
Yeah.
Understand that an average family would take about 2.5 to 3 years to save a single deposit.
Yeah.
Okay.
Yeah.
And that's like, you know, they're trying really, really hard to come up with a deposit.
Cost cutting with everything.
100%.
They're going to bring down the cost of living as well. So everything.
Definitely. But if you find the right property in the right state, in the right pocket, with the right due diligence, with the right help, that property can deliver that deposit for the next property literally 6 to 8 months.
Exactly.
Okay. And so what you're doing is you are basically amplifying your property portfolio and putting it on steroids and growing it really a lot more faster than what an average, you know, Australian would do. Where a lot of people think, and this question about, you know, you time the market versus timing the market, really important question, right? I'll share some statistics so that, you know, people get a bit of a gist around this, right? And average property growth anywhere in Australia right now sits at about 6.5%, which basically means that the property would double in value every 12 to 15 years, okay? That statistic around 12 to 15 years mark never changes on a long-term basis, okay? But we all know that the property does not grow in linear fashion. It's not that it's going to grow 6% every year, okay? And so some years it would grow 20% or 30% or 5% or 2% or no growth or go backwards, okay? That's how property market in reality works. But 12 to 15 year average always consistently remains the same.
Absolutely right.
Which means that if your property that you've bought delivers 70% growth in the first 6 years, it would still take the balance of the 6 years to meet the balance of the growth. And so all you need to do is be as close to the growth curve as possible. Okay?
Fair enough.
Yeah. And, you know, it's simple maths.
I never thought about it, but it's a very good way of actually looking at property cycle, because if you have already gained that 70% in 7 years' time, why would you want to wait for another 7 years to grow 30%?
100%.
Or even 20%. Sometimes you might not be able to reach the 100% potential. So you're looking at 85 to 100%.
Definitely.
So why would you wait for that 15-20% for another whole cycle to go through and for you to gain that money?
Exactly.
Rather reinvest that. I would rather potentially leverage the bank, take the money out, put it into another couple of properties, and let those grow at the same time as this property is going.
100%. The most important thing out of this is this, right? A lot of people, a lot of investors also make this mistake around looking at the past growth, and they think that that's a representation of the future growth. Okay? It's not, because I've just explained it to you, right? And so what tends to happen is that people think that because these suburbs have done 10%, 20% growth continuously over 5 years, 8 years, 10 years, that means that they're going to continue delivering it, whereas long-term cycles do not support it, right? What you actually need to look at is look at the 10-year trends of the suburbs, which are high in demand, low in supply, but have only delivered a growth of less than 6.5% annualized basis. Because you know that it's going to catch up. And that catch up is, if it's high demand and low supply, is going to happen very soon.
Especially when you're looking at a market right this, where we're coming out of a couple of wars, we're coming out of a massive COVID, the peak that we have of real estate market, and we have actually gone down to the values. Now we have only basically recovered to a value where the property market is to a sustainable level, but there's no supply in the market.
Definitely.
And that's pretty much all around the whole Australian continent.
Definitely.
The property prices are derived by the supply that you have in the market, and the supply in the market is not there because people are holding on to the assets.
Definitely.
And I think there was a data which came out this for this year that majority of mortgages during mid this year are actually coming up for renewals. So that's when
Yes.
everybody is like, oh, a lot of people will have to sell the properties because they're coming off the mortgage, which is 2.5%, 3% right now, and they're going to double up in value, which is going to go up to 6.29%, which the banks are offering. And the payments are going to go up pretty much to 100%. So they're going to go up from, if you have a $3,000 repayment, you're probably looking at $500 in the next few months' time, which is going to be a huge deciding factor for the property 100%. Market as well.
Look, I think a lot of Australians, you know, they have always seen, typically in property market, good times. They have never seen like really, really bad times. You know, I'm talking about GFC times in the US, right?
Yeah.
And so naturally there is this notion of first-home buyers, you know, granted access to, I need a home to live in. Okay, understand that a lot of mature economies where you talk about UK, India, China, Hong Kong, Singapore, Malaysia, there is no concept of first-home buyers.
No.
The houses are passed down generations. And Australia is on that path. Okay? 10 years down the track, everyone would be priced out. Like all of these first-home buyers would disappear.
Absolutely.
Because the market would be so far outreach from these people that the properties would be passed down through generations. Okay? And why would this happen? Understand this. And there's a very simple explanation to this. And I was explaining this again to another person before, that when you think about property market, okay, everyone wants the property prices to go up.
Absolutely.
Okay, even first-home buyers,
that's why they're buying it.
They want the prices to be lower when they are buying it. As soon as they've bought it, they want the price to go up. And so when there is a market where 99% of the buyers wants the price to go up, where do you think that the price is going to go?
Prices are going to go up. Plus the inflation is going to do the job anyway.
100%.
So the inflation comes into market. There's an inflation of 5% all across the board in country right now. Looking at that inflation rate, the property prices are actually around 6.5% to 8% right now. So which is not even correlating to what the property market should be delivering.
Definitely.
So what's happening right now is there's a period where we are in a trough of the property market. And once we get out of this trough, the peak of the property market is going to be very drastic than what we see. What we saw a couple of years ago before COVID, and literally after COVID as well.
100%. I think a lot of people, what they don't also realize is that property is the biggest inflation absorbing asset in the world after gold and silver. Okay, which means that, you know, property gets impacted as much by inflation as everything else. The only reason people see inflation is because they're going out and buying bread or butter or, you know, stuff because which is really quick, right? In property space, the inflation takes about 6 to 12 months to basically come out, right? And when you take this into account, the transactional cost of the property, so 5% stamp duty that people pay, and you know, relate over, because an average property changes hands every 4 to 5 years, okay? And so 4 to 5 years basically means that if you're paying 5% in stamp duty, that means 1% every year is where the property would at least go up by, right? You know, in logical sense. You add inflation on top at 7% and you compound it, all of a sudden you're looking at that growth rate of 10 to 12%.
That's right.
That the market has to deliver just to come to break even. Yeah, so that's the absorption that you're talking about, right? And a lot of people don't understand this, that this cycle would happen whether you like it or not, right? Because the bill prices have gone up, you know, the labor price have gone up. It has to replicate or, you know, reciprocate into the property market, and it's going to happen eventually.
So that's the best thing about a buyer's agency, I believe, that where you guys have done all the research in the background, because you guys go through a set of data, and especially with your background being data science, you look into the smallest of the smallest numbers and the biggest of the biggest numbers around the country. You look into suburban data. I'm pretty sure you must be looking into street data as well.
Yes.
So you look into everything around there, and you make sure that, you know, we are making a sound decision for a partnership that we are going to be forming for somebody. And if they buy an asset, that these are the variables that you guys are looking at, and this is why you're buying this property, and this is what this property is probably going to be delivering you. Obviously, there's not a hard and fast rule, or there's nothing out there which says, yep, stamped, this is what you're going to get in 5 years' time, $200,000 in your bank account. No, it doesn't happen.
Sure.
It could be 180, it could be 250. That's the gamble that you play when you're in the market. But the point is, you're making a sound decision. you're making a decision where you understand that this is what the market is.
Definitely.
And that's where you guys come into action.
Well, 100%, right? It's an evidence-based decision making, right? Basically, that's what it comes down to, right? A lot of buyers agents treat property as a transaction. For us, it's more about a relationship-driven business, and so we don't disappear from a relationship. An average age of a client in our ecosystem sits at about 5.5 to 6 years, which basically means that we are there when the growth is happening. And if it's not happening, we would catch it quite earlier in the piece as well. One of the biggest mistakes that I made earlier in my life, and a lot of investors would make in their earlier life, is they're not fast enough to identify the mistake and fix it. Because understand that property, you've spent so much time, effort, money on buying a property, you don't want to sell it in 1.5, 2 years, right? So you'll hold on to that, dead horse for as long as possible, right? And you'll be like, oh, there would be one day that, this would turn around and, become $1 billion or $1 million property, right? Whereas if you treat property as a business, as an investment class,
just get rid of it.
And so you need that sounding board next to you, telling you when to buy, but also when to sell, when to come out, right? A lot of people are not actively or proactively involved into property investment. And so a duty of a buyer's agent is not only to help you buy the right property or right investment grade property, looking at all this data set and helping you make an evidence-based decision, but also stand beside you, proactively guiding you into making, a bigger wealth created property portfolio, right? So they should be there helping you along the way, right? I never claim to say that, okay, every suburb that we say or pick is going to, deliver, 100% growth in 6 years or 7 years, right? But touch wood, over the last 10 years, every suburb that we have picked has delivered the growth. Yes, some suburb has done significantly better than others, right? But ultimately, that you are still better than the Australian average.
Absolutely.
And that's what you're trying to beat, right?
And you want to beat the odds.
100%.
And the odds are against you at the end of the day. When you're buying a property where you haven't actually done the research in the background, you don't have the evidence of buying the property or data that you guys go through, because it's an immense amount of work that goes in buying a property. And you guys coming into picture and having that old data set, plus you have the former experience of working in those areas, former experience of working with the real estate agents, so that you can have that buying power where you could potentially bring the prices down of the property itself.
Definitely.
So you're buying in a way better position than you're buying normally when you're in the normal market.
Definitely.
So even if you're saving $20,000 on a $400,000 property, that's a huge amount of money.
Definitely. Look, buying is as much as a science as it is an art.
Exactly.
Right? So when you talk about science, you're talking about all this data. When you talk about art, you're talking about negotiations. You're talking about being on the local, being on the feet, understanding the dynamics, understanding which side is the good side and the bad side. We look at a lot of crime data.
It's much
these
important.
days. I mean, it's so important. What languages do people speak? What crime data? What schools are there? That are impacting some of these suburbs. And so some of these data is so powerful, and it's not readily available to a lot of these people, but we are looking at it on a day-to-day basis. Understand that as a buyer's agent, we buy 5 to 6 properties a week. Okay? You would buy 5 to 6 properties in your lifetime.
Absolutely.
Right? And that's where the difference is. We are so unemotional about it that you would walk away from a property because you know that the numbers don't stack up, right? It's all about the numbers, right? Whereas as an investor, if you're trying to do it yourself, because you're treating this as an event, you'd be like, look, I've been looking at this for 3 months.
I'll buy this one now.
I'll just be done with it, right? I'll just be done with it. And so what tends to happen is that if you're making that decision 4 or 5 times, there's a good chance that out of those 4 decisions, 2 are right and 2 are wrong. Right? And so why would you do that? Like, for a $500,000 purchase, why would you make a wrong decision?
Why would you? Why wouldn't you actually use somebody who actually charges you a very minimal amount for the time and expertise that they bring to the market? And that's the profession they have. That's the professionalism they come with. That's what they do in daily life. And property buying, or let's say property buying, or if you're buying anything else, you shouldn't be making an emotional decision when you're looking for a return.
Definitely.
It should be a decision where you understand that this is going to provide value and this is going to generate something where I could potentially use it for my child's tuition fee when he's going to the uni. So that's the mindset that a person should have, that you don't want to be looking at gains that are happening in next 2 years' time where you go for a vacation to New York.
Yes.
You should rather be looking at a time where you're like, when my son goes to high school, I really want to make sure that he has a great car, and I will probably sell this property, bring that cash out, buy him that $60,000 car, and use the rest of the money when he goes to uni.
Definitely, yeah.
So it's a
improving
long-term
lifestyle.
gain.
Yeah, improving lifestyle is one of the key things of you generating wealth, right?
Yeah.
It's not so much about waiting for that D-Day, the retirement in the future for you to provide. The whole idea about creating wealth through property is improving your lifestyle along the way,
Yeah.
right? Yes, drive that expensive car. Yes, fly business, right? There is nothing stopping. If you have the passive income to support
Exactly.
there's nothing stopping you from doing that, right?
Absolutely. Thank you. I have another one for you, but which we have pretty much covered in this one here, so I'm going to skip this. But the biggest one that I have right now is because the interest rates are on the high, right? So how do interest rates and loan terms impact an investment property cash flow?
Sure.
Well, what is the major thing which comes into action when you're looking at both of these things here? And how do you tell a person, let's say I'm a first-time investor, and obviously, I've been hearing that from my friend that, interest rates have gone up. Oh my goodness, I'm going to be dying if if they go up by another percent, because I am paying $3,600 in mortgage right now. That's going to go up to $4,100 by 1%.
Sure.
So, those kind of, as we spoke about, barbecue conversations that you have, and your mates are pretty much your best mates or the worst enemies of you buying an investment property as well.
Yes.
So in my days, when I used to sell real estate, I remember, majority of the transactions, and we would go to training days, and that's where the trainers would be like, majority of your transactions are probably going to fall over on a weekend when your person who was going to buy the property has met another person who has had a very bad transaction in real estate and never bought a property ever again, never made money for himself, but he wouldn't let that person make the money as well, because he would negatively impact that person for a long period of time.
Definitely. Yeah, 100%. Look, when you're talking about navigating through higher interest rates environment, right? Ultimately, what you need to understand is that you should never be over investing in the first place.
Yeah.
Okay? And so having a strategy in place basically helps you navigate through some of these scenarios. I always say to people that you need to understand where you are and where you want to be 10, 20, 30 years down the track. Okay? What are your passive income targets? What are your net wealth goals? And you work backwards from there, okay, basically.
Yeah.
And so you identify what type of properties, what yields, etc. Now, if you haven't done that thinking, and if you have been shooting in the dark, I've used this example on a podcast that, you walk into a nightclub which is dark and you're winking at people without even realizing whether they're male or female, right? Basically, that's what a lot of investors do, right?
That's what a lot of people do.
Yes. And so if you have been one of those people, and that's fine, there is a lot of investors out there who have done that, right? And you are in a position where, the interest rates are rising, you've been eating away your savings. Yes, there are ways to basically manage this, okay? Number one is, of course, the easiest one, where you are killing away your discretionary expenses, okay? That's the easiest quick win that you're going to do. While it's not favorable, it's not, it's not something that I would, ask people to do. But, naturally, that's what you want to do. You shouldn't be selling properties, just because you're feeling the burn. That's number one. Number two, look at your property portfolio and see, can you push the yield up? Can you convert it into dual properties? Can you, convert it into co-living property? Can you charge a higher rent? Can you change a configuration of the house by spending a little bit extra? Okay. Can you do a granny at the back too? Can you do a granny in your own house at the back? So, there are some of these opportunities within your own property portfolio where you can push the yield up quite quickly without you even realizing it. So you need to do that assessment for your first self. Okay?
Leverage the bank as well at the end of the day, I would say.
100%.
Because if you have a little bit of equity in your personal house and you're looking for something, then you're potentially not paying anything out of your pocket.
Definitely.
And all you're doing is you're getting bank to pay for your deposit, you're getting bank to pay for the whole price of the property as well.
Definitely.
And in that scenario, even if you're topping up the property by $3,000 to $4,000 a year, that is nothing to what you would potentially do when you have paid $80,000 of deposit,
100%.
which is 20% of $400,000 property, and then you're chipping up another $4,000 annually. So that becomes a burden.
Definitely.
In this scenario, this is way better because you have potentially got the bank to leverage it for you, pay everything in the whole scenario, and then all you're doing is just servicing it for next 5 to 7 years time.
Definitely.
Which is around $40,000 across the whole board.
Definitely.
And the amount of gains you're looking at, as we said,
definitely
70%, then you're looking at $650,000 of property value.
100%.
Which is $250,000.
So I think that's a really good segue. So, a lot of people are sitting on a lot of equity, right? And so one of the easiest way to manage your cash flow, and this might sound a bit stereotypian, people would get confused, is to buy a property that offsets a lot of negative cash flow within your property portfolio. Okay.
Yeah.
You know, there are properties like rooming houses, co-living properties that we were talking about that can generate 12 to 15% returns for you. You know, even in the IS space, that generates significant amount of returns for you. Yes, manage your risk, go with the right company, do your due diligence. But, you know, getting one of those into your property portfolio basically solves the short of, you know, even commercial property solves a lot of these problems for you. Yeah. And last but not the least, you know, understanding your mortgages, you know, recasting your debt. Sometimes managing cash flow is as easy as, okay, you've been paying this loan for 6 years or 7 years. All you just recast your debt.
Absolutely.
To the next 30 years, you know, rather than, you know, paying it for the 25 or 24 or 21, just recast it out. And that would basically reduce your cash flow. Yes, you would be paying a bit more in interest, but at least it helps you in this burn time in order to manage your cash flow.
But then the whole point is you're not paying the mortgage for 30 years.
Yes. Yeah, exactly. Like people don't understand that, right? I think people's natural mindset is that, okay, I'm going to pay this for 30 years and die here, right? And basically that's where a lot of this translation is lost, right? You know, you don't have to pay it for 30 years, right? You know, you can pay off your mortgage in literally 5 to 7 years if you really wanted to.
Never have I ever met a person who has actually paid a full mortgage on a property from their pocket.
Yes.
Every time I've actually seen a person who's got a mortgage-free house right now is a person who has actually bought a couple of investment properties in past, sold their properties, and they actually strategized in a way that that's the financial goal they wanted to achieve.
Definitely.
So they cashed out at the time when they wanted to cash out. That paid for this property again. Now they have a mortgage-free property, which is $1 million or $2 million sitting in cash with you at any stage, because you could go to a bank, put this property as a mortgage, and then you have a couple of $1 million worth of loan which is sitting right there for you to buy another property 100%. And go into cycle for next 7 years and 100%. Whatever you want to do. So
100%.
It's not about you paying the mortgage. It's about letting property pay the mortgage itself, and you are generating wealth for yourself and time for yourself.
100%. So ultimately, that's what the choice is, right? You know, when people talk about financial freedom, I always say it's not financial freedom; it's actually financial independence, right? And so there is a fine line between the two. Financial freedom is all about people saying, "I want to be debt free," right? And I say, what good is debt free? Like, how is that great?
Exactly.
How is that great, like debt free? Because you have a lot of lazy equity doing nothing for you. You still have the dependence on the paycheck, right? Financial independence is where you have the passive income and you still have a debt.
Exactly.
And you're not worried about that debt. No. And you sleep, you know, I wouldn't say like a baby because babies don't sleep like a baby.
We know that.
Yes. But, you know, that's the whole notion of having financial independence. You have a passive income, your debts are covered, you don't worry about the debt, and you're getting shit ton of, you know, passive income coming back to you, and you're growing wealth at the same time.
Yeah.
And that's the perfect scenario that you need to
And you're not actively working for somebody. You're rather basically putting all your energy into property market, and that's what you're analyzing, and that's what you're working towards. 100%. That, you know, all you want to do is acquire properties, do more acquisitions, and have more cash flow and more passive income.
100%.
So
see, the most important thing is this, right? And I was talking to a client just recently, right? And so they were very focused on saying, look, my house is paid 60-70%, so really high income earner, right? My house is paid 60-70%. I don't want to touch the house. I want to build a property portfolio based on the cash that I have. And they were sitting on $200,000-$300,000 in cash, right?
Fair enough.
And I was like, look, you know, your problem is not cash flow because you're making about $600,000 a year. I understand that, right? But understand that, you know, this cash that you have, you've paid tax on it already, right? This is disposable income, right? This money that you have in your house is a non-tax deductible debt. If you take it out and buy a property, that changes into a tax deductible debt.
Exactly.
So why would you use your money that you've paid tax on and try to convert it into a tax deductible debt when you have access to free money from the bank that you can convert it into a tax deductible debt, right?
Fair enough.
And so so he's an accountant, by the way. He's a financial controller of a really, really big company. And he just paused and he's like, holy shit. Like, I never thought about it.
Yeah.
And I was like, it's simple things like these where you just have to take yourself out of the equation and make an evidence-based decision, right?
But then it's again emotional.
100%.
Being emotional in the market. So you want to be that's why you need a person who actually doesn't make an emotional decision.
Yeah.
He's a professional, comes to you, tells you what is the best strategy that's going to work for you.
100%.
And, you know, he's not going to be blinded by the fact that this is what I want to do, this is how much money I have here, this is what my equity is. He's probably going to look at the whole scenario where
Definitely.
they tell you this is the best achievable thing for you, and this is how you save money and tax.
The funniest thing is that, some of my directors come to me when we are doing strategies, and they're like, Moss, let's pan out the strategy for me, my property portfolio. And the reason that they are using even our own services is because they know that they'll get emotionally attached to some of these things. So they're like, no, we need to be as unbiased as possible. And so let's sit up into a strategy session so you can basically tell us how to navigate through some of these things. And it's, as I said, it's a process. If you follow the process, you come to the right outcome, right? If you treat it as an event, you would always, have a bit of a party, lose a lot of money.
Sputtering down.
Yeah, that's it, right? And so,
Fair enough. Fair enough. We're probably going to take a break.
Yeah, sure.
And then do a part 2.
Yeah,
because
sure.
then it's going to be too long of a video.
Yeah, sure.
And so we're probably going to take a break, and we're going to continue this in a part 2. And we have a few more questions for you guys to actually go through and understand how, what, and when to get into a property.
Thank you very much.
Gives you a little